This person asked me, can you explain the difference between doing less bad, doing more good, and doing new? But please with examples, not in theory. I'm currently testing the sync of my past trades. It feels like it's a matter of how you frame your analysis to if this is a review for doing less bad or more good or new stuff. Okay, let's break this down. So when we're doing less bad, we're just trying to identify what are EV negative inputs or what are variables such that if they are present in our trade, they literally harm our EV. This, I don't want you to confuse this with this is lower EV than I normally get. That's not what I mean. So if you have something which, like if you have some variable which is giving you like 0.05 R of EV every single time it's present versus some other thing which is like 0.02, doing less of this is not what I'm saying. Just because this is worse than this doesn't mean that I'm saying, oh, we need to do less of this, right? I'm saying things which strictly cause you to literally lose money. Literally lose money. So what are some things which literally, like, they cause you to lose money? They are EV negative, like no matter what you do. So they mainly come in the forms of costs, right? Costs. So we have fees and we have slippage. So these are like blatantly EV negative things that if we were to optimize them or improve them somehow, we are going to be making more money. So fees, we can't really, like, there's only so many quick hacks that we can do with fees. But a simple one would just be sign up to an exchange using the referral link of your friend. You can try to sign up to a referral link based on your own account and try to farm the kickbacks like that. But I'm like 99% sure that if you do actually do that, that it's against the terms of services of some exchanges. Maybe they will take the kickbacks or the extra referral bonuses back from you. Maybe they'll suspend your account. I don't know. I wouldn't that's why I don't recommend doing it. But like I've heard people, they just ref link themselves on their own account. But yeah, I would recommend easiest route, just use a friend for a ref link. So there's that. Option 2 for getting lower fees is to build your social media presence, because if you can land a partnership with an exchange, one of the things that you might be able to negotiate with whoever is your account rep is you might be able to negotiate a smaller, slightly better fees just specific for your account. So not only do you will you get kickbacks on referrals, but your own trading account that you have to give them like your user ID for your exchange, and then they will literally assign you like a special like a VIP fee structure where you don't have to meet a certain volume criteria to be given the smaller fees, but you might have to meet a certain referral volume to get better fees. So that's like another thing that you can actually do. So yeah, you can build your brand, like build your social media presence to get better fees, or just simply do more volume. But I think there's just that. What was it? Yeah. So brand, build your social media. The second one is referrals. So your own referral link or the referral of someone else. And the third one is just volume. So how do you crank out more volume on the exchange to hit the fee bracket without actually harming your P&L? So is there a way to crank out volume in a way where you actually make money? So that's one thing. The other thing where you can do less bad is if you come up with an idea, you test the idea, you look at the stats of that idea, and it turns out every single time that this thing is present in your trades, your win rate and your risk reward is actually EV negative. We need to take less of those trades. So, example, let's pretend that you are trying to improve a momentum trading strategy. And you have found that when you have this same exact staircase pattern, but it's below the VWAP, and there might be like some resistance level that you are hitting into here, right? And this is like the past 2 hours of price action, and the volume was increasing during this time. But let's say that's the VWAP. You might say, oh, I have found that actually that when I'm taking the same exact momentum trade with 2 hours of staircase and increasing volume, when it's below the VWAP compared to above the VWAP, I make more money. And actually, maybe hypothetically, when it's let's just pretend that when I take the exact same trade when it's below VWAP, I have a 50% win rate. So it's EV negative, right? Or maybe it's like just barely teetering on like no EV, right? And my logic, this is how I think about things. When something is very close to zero EV, I just assume that it's negative, because I have to take into consideration like, okay, well, slippage is like a partially unknown cost, like it's somewhat of an unknown cost, and I have to take that on a situation where I'm not actually getting EV, so I'm probably going to be losing money after I get hit. If I get hit with slippage even once, I'm going to be losing money, right? So let's say something here is like a 50% win rate, and then let's say this idea is, let's say, 53 on average. Then I'm just going to stop taking these entirely. So like, how can I remove trades which I strictly do not want in my data set, or I don't want them to appear in my journal ever again? So we want to do less of those. Doing more good, this is identifying an EV positive input, looking at how many times you can do them in that exact same input over a 30-day window of time, and then seeing how can I crank out more of these. So for example, you might have a nice day trading strategy, but let's pretend that it is purely discretionary, or it is mostly subjective, or it is mostly discretionary, and you only have, let's say, out of this 24-hour period of time, you can only capture that edge here, right? And let's say that on average, we actually get, let's pretend that on an average 24-hour window of time, we get X number of opportunities. So let's say it's 10. But then during your trading window, right, your actual window of time that you're online ready to trade, you might only be able to witness maybe 2 of them. So how many opportunities are there available actually with your edge, and how many of them are you actually capturing? So what is your capture rate? So you're only capturing 20% of the opportunities that are actually available. The only reason why you're missing them is because you're literally not in front of the screen. So if we just simply increase your screen time, you're going to be capturing more of those opportunities. Alternatively, if you have your trading session, and your trading session is split into 3 different categories, where you have your pre-session, your mid-session, and your post-session, and we can decrease the amount of time that it takes you to perform your market scan, or we can decrease the amount of time that it takes you to do a post-session review. Let's just pretend, hypothetically, it takes you 30 minutes to do this, it takes you 30 minutes to do that, it takes you, and then in your actual trading session, you're in it for 120 minutes. Let's say we drop the time it takes you to do a market scan from 30 minutes down to 10. So we basically get plus 20 for the time that you can actually spend on trading. And then we also drop the amount of time that it takes you to review your session from 30 minutes also down to 10, where you get an extra plus 20 minutes. So you found an extra 40 minutes for your execution time. So 40 over 120, what is that? It's 30%, I think, or 33%. I think so. Yeah, 33, right? Am I right? Yeah, 33. Okay, so that basically means that your capture rate should be reflected by this extra change. If you manage to increase the amount of time, your screen time of execution by 30%, then you should, in theoretically, be capturing 30% more opportunities. So maybe on average, instead of catching 2, maybe you catch something like 3, right? Or maybe let's say over a month's period. So in a total month, in an entire month, the number of trades that you capture, let's say, is 30. But the actual total number of opportunities that were available were 300. So if you get your capture rate up to 33 out of 300, then that's awesome, right? We are making improvements of doing more good, right? But by doing more positive EV inputs, and finally when you get your capture rate close to 100%, and that the only time that you achieve that is either A, if you discover a form of alpha where you no longer have to sleep and you can just literally be in front of the computer screen 24/7 without it literally killing you, then that would be a form of alpha. Or alternatively to that, if you find a way to automate, to fully automate your execution, which is probably easier than than the first option, then you'll be capturing 100% of your trades, or maybe close to that. Maybe you're not fully automating it, but maybe you're automating to capture maybe not all of your trades, but maybe only your A pluses get automated and captured. And maybe you get like some extra execution while you're asleep, but only on these A pluses. And maybe on the A's and all of the trades which are graded a little bit below that or aren't literally perfect, your bot or your whatever system that you built actually doesn't manage to successfully capture it, right? Because it's not literally perfect. So yeah, it's either you can optimize the capture rate of the strategy that you already have, or option 2, you're going to have to go into new. Okay. So doing more good, this is basically you're increasing the number of trades that you are currently able to capture with your strategy. But once you've really cranked that up, you can't capture more. Okay, actually, you know what? Before I go into new, another example of more good is the same strategy, maybe not necessarily over different times when you're not awake, but it could be the same strategy, but in a different market. Maybe you're only capturing trades with your strategy in altcoin perps, and maybe your strategy could be maybe slightly worse in equities, but it could still be profitable in equities, but you just don't know. And maybe there could be a similar frequency of opportunities in equities, but you simply just don't know because you haven't tested it, you haven't got the data, so you have no idea. So you're not actually capturing the real amount of edge that your edge has. You're missing out. So it could be because of a different market. It could be because of a different time frame even. Maybe your strategy works just as well or brings in very similar or correlated returns on different time frames, but you just simply don't pull the trigger because you don't want to pollute your journal with more stuff, or you don't want to be involved or have risk stuck in a position for a really significantly long period of time. I don't know, right? But it could be different time frames, it could be different markets. But basically what we're trying to do with more more good of the same strategy is how do we capture more opportunities of that exact strategy? How do we increase the capture rate? And then finally, that brings us to doing new. So this is when we start moving away from your standard momentum trades, standard mean reversion trades. Maybe you start looking into, I wonder how well momentum and mean reversion trades will look on synthetic markets. Or what I mean by that is you're not looking at alt USD, but you're actually looking at the price action of alt against another alt. And if you do, let's say, for example, WIF divided by Pepe, you're going to get, your trading view is going to, it's still going to print a time series. Like you just do, I want to show a chart, or I want to visualize a chart of one altcoin, the price of one altcoin divided by another altcoin. And you might get a time series that maybe your edge might work in there. Maybe if Pepe against WIF has some specific pattern that matches or aligns with your strategy, it might actually show that WIF is trending to be more in value relative to Pepe, and maybe there is a breakout trade to be made there. But the way that trade needs to be executed is long WIF, short Pepe, and you can't really put like a normal stop loss on a trade like this. You're going to instead have to use like a separate platform for this. I think there is an app called Pair Trade, like PEAR, Pair Trade, or you're going to have to build your own like little system for, okay, if price 1 divided by price 2 drops below a certain threshold, then both of the positions have to get closed. Something like that. So it's similar, but it's still kind of different because you're running it on a different market. I don't know if I would call this new, or if I would just call this I don't know if I would call that new, or I'd call that more. Actually, you know what? I might actually put that into more, because it really is the same strategy, but it's just in a different market. Okay, a better example of new might be instead of you doing momentum and mean reversion on the price of stuff, you could look into arbitrage. So you could be looking at arbitraging funding rates. You could be looking at arbitraging spreads. So either the spread of the funding rate or the spread of price, or maybe you have some method where you're taking advantage of a bug on an exchange. So, okay, an example of this is I remember someone was running a strategy where on FTX, the way that FTX released some they had some products where it was like BTC Move. I think that's what they were called. They were BTC Move products, and then there were also like shitcoin. I think they were called like shitcoin indexes. I can't remember exactly, and the ticker was literally like shit USD, something like that, and it was like a basket of like the top 100 altcoins or something like that. Anyway, I saw I can't remember where I saw it. I think it was somewhere on Twitter where some guy was talking about how he found some way, or he found some little exploit that FTX had a very poor method of rebalancing or pricing these products, or maybe like with the shitcoin. I can't remember exactly what happened or exactly what the thing was, but basically how the exchange was measuring the fair value of something was off, or maybe it was something like how the exchange was rebalancing their own exposure to these products, or how they were making the market on some of these products, it was very predictable. So like 1 hour before the daily open, they would go slam a whole bunch of market buys and market sells across all of these altcoins, like 1 hour before the daily close, to do all of their portfolio rebalances. And they would also be TWAPing it. So over that 60-minute window of time, you could basically capture and take advantage of any like imbalanced flows of the market orders that are coming in. So it's like you're looking at completely different strategies, which have absolutely nothing to do with the strategies that you currently run. I guess I could say new, when I'm talking about new, I'm saying anything where its equity curve has a very low correlation to the equity curves of your current strategies. So I guess that's what I mean by new. So less bad, costs, slippage, fees, and how do I pay less fees? How do I get screwed less in slippage? More good. How do I capture more trades with my strategy by either reducing the amount of time that I spend in my pre and post session, or can I keep this exactly the same, but test if my strategy works on different time frames in different markets, and even you could go a step further, even in the synthetic markets like alt or basket of alts compared to another basket of an alt. Maybe that's another one, or a basket of alts against a basket of equities. Who knows, right? The possibilities are endless. But same core idea, but a different way of executing that same core idea. And then new is just new idea entirely that has nothing to do with your existing ideas. So weird forms of arbitrage or things like that. Or another example of this would be angel investing. So another strategy that you could do is every time that a coin happens to look semi-good and it happens to be in a specific industry, maybe you do warm reach out, you make friends with the founder, you literally meet the founder and the team in person, and then based on whether they meet a certain criteria or they checked all your checkboxes while you met them in person, maybe that could be a leading indicator for whether or not, like, how bullish or bearish you are on that team. Okay, example. Let's say the founder of a coin which is promising new tech is literally like the ex-head engineer of Claude or ChatGPT. I don't know, something like that. Probably not too shabby, right? Probably a little bit more bullish on that. And let's say you meet them in person and they're like really driven, they're like really focused, they clearly know their shit. It would be like, okay, wow, this guy's smart, I'm bullish on him. And then people I know have also vouched for this guy. I'm very bullish on their project. I think they'll be able to pull it off. Polar opposite example. There's a dude, he's like severely overweight. He's rugged a bunch of different projects before in the past. Not like very weird vibes IRL or in real life. Not maybe like sleazy attitude. I don't know. Maybe not something that you would want to invest in, despite their marketing looking clean, despite them getting a whole bunch of engagement on social media, right? So that's like another entire different category of strategy. If we take this a step further, this could be, okay, I don't want to trade financial products. I wonder if there is edge in physical products, Pokemon cards, luxury goods, cars, watches, deodorants, arbitraging physical products on live social shopping like Whatnot or TikTok Shop, right? Maybe there's like an absurd premium. I remember I saw this dude who made like, I can't remember what the number was, but it was like something close to 6 figures on arbitraging inflatable pools from Walmart. It was Walmart, Amazon, so those were the two venues. So he would drive to Walmart stores, buy up all of the inflatable pools, and then flip them on Amazon for like a huge premium. And it was like very specific to inflatable pools. And I think the reason was something like it was during summertime, and there was like a significantly high demand for pools during that time. Or there could be an edge where, let's say you find a way to make candy canes, to make like 1,000 candy canes for like 1 cent. But there's but let's say supermarkets will pay you like $1 per one candy cane, and they resell it for like $2, and you're like, all right, I will literally give you like 100,000 candy canes throughout December, and maybe that edge produces, I don't know, like 10 or 20K, but only for December. It's like a very seasonal type of mispricing that you could get away with. And it only occurs in December because it's like a Christmas thing, and there's like huge mispricings for candy canes and that type of candy towards Christmas, right? So that's what I mean by new. Something which is like completely unrelated to the strategy, or to the edge, or to the mispricing, or the advantage that you're trying to use right now. So when you're doing sync, when you're testing things related to sync, what you're really doing is you're just doing this. It's basically the same strategy, but better. You're just trying to optimize the way that you are already doing something. So this has very little to do with doing new stuff. Anyway, I hope that answers the question. If I missed anything, or if you have any follow-ups, just drop me any questions or anything that you want to talk about in the comments below, and I will get back to you with a video format just like in this video. Anyway, thanks again for the question. And by the way, if you're serious about improving as a trader, I'd like to invite you into my free Telegram. Here's what you're going to get inside. You're going to get a 100-page guide on how I trade breakouts. You're also going to get a 214-page guide on how I trade reversals. And by the way, these two guides, I go really, really in depth with the strategies, with the theory, with the logic, and also I include like total combined within these two guides, there's more than 75 trade screenshots for you to study, like through just continuous repetition, and it's going to help you train that pattern recognition of seeing the exact same thing happen over and over again. Also, you're going to get a custom trading journal that I built, which makes it really easy for you to track your trades, but also to review your trades. Like literally in the journal, there's a tab called educational resources. And in there, I have a template for reviewing trade screenshots and guide to show you the process for how to actually review your trade screenshots to improve your performance over time. And also a whole bunch of other stuff as well that I give out for free in my Telegram. So if that sounds interesting, click the link in the description to join.